Good morning. Good morning. How's everybody?
Good morning, Professor.
Good
Yeah, good
morning.
morning, Angelica. Good morning, Naomi. How
Good
are
morning.
you? Good, good. Okay, I see 8 people, and how many people are in the collaborate? In the discussion board. I see 9 people in the discussion board. So we need just one more person to join our collaborate. All right. Um, so in our last class, we have now 9 people. Good. Uh, why does it say I have 10? Yeah. Um, so we didn't quite finish the income statement last time. I was just wrapping up the discussion about the explanation about the indirect cost, which is called operating expenses, and these are basically fixed costs. Okay, so hence it is also called total fixed cost, right? But then fixed as opposed to variable, right? And as an example, um, uh, something like rent, or there are fixed costs. Every operating period, there are fixed costs such as rent, or administrative, uh, the salaries paid to the administrative or clerical staff, marketing expense, R&D expense, depreciation. These things are fixed in the sense that they don't change with the output level, right? Regardless of whether the production level goes up or goes down. Uh, these costs don't change. Hence the fixed cost. But I told you it is slightly different. Operating expenses, OPEX, that's fixed, right? Constant. But I told you it's a little bit different from total fixed costs that microeconomics, total fixed cost in microeconomics. So I said it's only roughly equivalent to each other. I'm going to come back to why. It's not exactly the same thing. Um, but let's get back to the big picture. Okay, let's get back to the big picture of the income statement. The big picture is, so think about it. We have all the expenses now detailed out. We have all the expenses. First, there's CGS, cost of goods sold, right? Which breaks down into basically, average variable cost, right? Times quantities built, right? Quantity built or quantity made. Um, uh, but in our example, this is actually this is slightly different example from the manufacturing case, because when I explained it, I used manufacturing as an example. The components of the CGS in this example is retail. This is a typical example of retail. And if you think about it, retails don't, in retail, um, retails don't have any plant and equipment. Retails, they don't make things, they just buy the finished goods from the manufacturer. So in retail's case, they will only express the CGS by the inventory, right? So I'm gonna come back to that later. But anyway, we have identified the CGS. We have identified the OPEX, operating expenses. So then what comes next? What do we do? And when I ask this question every semester, what comes next? I mean, what is the next action? What do we need to do next? And they all miss the point. All I'm asking is, what is the verb? In other words, what do we do? What do we do next? Then the answer must be, we do this, right? We do this, right? What does that mean? That's the verb. I'm asking, what is the verb that what is the verb that describes our action? What do we do next? And the verb is then subtract. Of course, we have to subtract, isn't that right? We have all the income detailed out. We have we have identified the income. Mainly, it is revenue. Mainly, it is sales revenue. And then we have detailed out direct cost and indirect cost. So we have identified all the costs. Then what we need to do next is subtract the expenses from income. Isn't that right? And that's what I'm asking. But they all, every semester they come up with all, they say we take profit. Yeah, I mean, that's roughly, that's quite close answer. But what do we do to take profit? I mean, the profit is still not the exact term here. It's not the exact term. But think about it. We all know, I mean, it's all etched in our human DNA, right? By instinctively, we know, right? It's our instinct. When we have income and expenses, our instinct tells us to subtract the expenses from income. Isn't that right? I mean, even a third grader would not understand the concept of income or expenses. But the point is, income is money coming in. Isn't that right? Expenses are money going out. Right? And as long as a third grader would even understand that, I mean, as long as the third grader understands that this is income coming, this is money coming in, and this is money going out, right? Even a third grader would understand that the right course of action, next course of action, is to subtract, right? Subtract the money going out from money coming in. Isn't that right? Wouldn't everybody agree?
Yes.
Even a third, yeah, Angelica, yeah, isn't that right? Even a third grader understands that if it is money coming in, this is money going out, then even a third grader would know that he or she should subtract money going out, right, from money coming in. Yeah. So that's basically the bottom line. So we subtract all the expenses from income, and then we arrive at operating income or operating profit. Now, I said this is roughly profit, roughly. I mean, think about it. You subtract cost from revenue, subtract cost from revenue, then that's roughly the concept of profit. But it's not net profit just yet. It's called operating profit. Okay, it goes by 3 different names. First, operating profit or operating income or EBIT. EBIT stands for earnings before interest and taxes, right? Earnings before interest and taxes. So that means, this is the profit before paying interest and taxes. Okay, so earnings is the same thing as profit. Now you can come to most of you can understand now that, oh, earnings is the same thing. Earnings means the same thing as profit. Yes, yes. But then, because this is called also operating income, then and operating income is the same thing as operating profit. Does earnings mean the same thing as, is income the same thing as profit, or is income the same thing as earnings? No, the answer is no. Why? Because income is gross state, right? This is income. In other words, before subtracting anything, right? Income is, in gross state. So if you say just income, it means this. And calling this operating income is a little misnomer. I mean, this is what accounting does. In accounting, they use the term income over and over, repeatedly. Now, personally, I don't like to call this operating income. I don't like to call this operating income. Why? Because income is inherently gross state, and if you subtract it, if you or net out, if you net out or subtract all the expenses, then at that point it shouldn't be called income anymore. But accounting keeps calling it income, operating income, taxable income, net income, and this is, this is crazy. I don't approve. If I have to, if I have the authority, but all these, terminologies are, um, there is no code. There's no code or law that says you must use this terminology only. But usually accounting practices are, standard accounting practices are defined or by GAAP, GAAP, generally accepted accounting principles, generally accepted. So, in other words, there is a consensus, but it's not absolute. It's generally accepted, and it is, set by Financial Accounting Reporting Bureau, Financial Accounting Reporting and Standards Bureau, FSRB, FSRB, or Financial Account. Uh, so, but that is not. It's just like, it's not a law enforcement agency, right? It's just, they just provide guidelines, and generally, as long as it's generally accepted, then it's okay. So that's why in accounting they have this. They use the term income interchangeably with profit and earnings, but I will come back to this later. Um, for businesses, for corporate income statement, for businesses, profit is the correct term. I mean, it has to, but if it is not business, but if it is individual situation, personal, but of course, what kind of individual keeps income statement? I mean, personal, there can be personal income statement. I mean, you can keep your personal, you can record, you can keep your personal income statement. Okay, but it's not required by law, right? And then it doesn't. I mean, it will help you, uh, for personal purpose, right? For personal tax purpose, it can help you to correctly uh, calculate it, to correctly calculate the taxable income. But in corporate case, uh, but in personal case, it's not required, right? But uh, in corporate case, right, balance sheet and income statement are required by law. I mean, not only for their own operational purpose, but and accounting purpose, but also for um, especially if you are a publicly traded company. Publicly traded company means the company that sells stocks in the stock market. Not all the companies can sell stock in the stock market, right? You have to meet the, you know, the requirement, basic requirement by the stock market. So there are tons of companies that are, not traded in the stock market, but they also have, for their own managerial purpose and accounting purpose, they have to keep balance sheet and income statement. But especially if it is a publicly traded company, you have to, but it's required by law, okay? And because you have to disclose your financial information to the public, otherwise, you cannot sell stocks in the stock market. If you don't disclose your financial information, right? And because why? Because there's no transparency. If you don't disclose your financial information, there's no transparency. And if there's no transparency, investors won't invest in you. And even if, prior to that, it is required by law. So anyway, in the case of corporate income statement, it's better to call it profit. But if this is a personal case, profit is not the term, right? If it is, your personal, about your personal income and expenses, right? You don't, as an individual, it's still income, not profit, right? Because I told you, if this is personal income, right? What is equivalent to your sales revenue is your salary. Your salary is the revenue for selling your labor, right? That's why it's also called, earned income or labor income. You can also have investment income because, from your savings, you can invest and you will invest, and from that, you will have investment income. And then your expenses will be, you have fixed costs such as, food, shelter, clothing. At least there are some, fixed, there may be slight variation. I mean, sometimes you buy more clothes, sometimes you buy less, sometimes you eat more, sometimes you eat less. But your rent, or if you own a house, you have mortgage. They are fixed, and they don't vary. They don't change with your production level, and your production also. Telecommunications, transportation. I mean, if you're self-employed, transportation. I mean, you have to drive to your work. But this is if you are a salaried worker, if you have a permanent job, and if you have to drive to your work. This is a fixed cost, right? Because you work, like 5 days a week, 4 weeks a month, and your commute will be the same thing. I mean, whether you use a mass transit or whether you drive, this will be relatively constant transportation, right? And work-related telecommunication will be relatively constant. It will be done at your work, so you don't. But if you're self-employed, right? Then transportation, telecommunications will change with your production level. If you have more job, if you have more work, you'll commute. You'll drive more. Work-related, telecommunications, it will increase, right? If you're self-employed, right? There will be, variable cost, right? But so it's pretty much the same. The structure will be pretty much the same. And in that case, think about it. In that case, subtracting all the expenses, then what would you call this? I mean, if you're self-employed and but you're not, you have not, you're just self-employed, but not, not, you haven't formed a business. I mean, at least, if you have a sole proprietorship, it's just a one-man business, but sole proprietorship is registered with the municipality as a business, as a legitimate business. So then, in that case, you are a business. But self-employed, you're not a business. So if you're a business, then you can call this profit, but sole proprietorship. But if you're not, just self-employed, then it's not called. It cannot be called profit. It's just still income, right? So if this is a personal case, then calling this profit is not the right thing. I mean, it cannot be wrong, but calling this income is relatively more appropriate for the personal income case. So that's, in a way, it leaves a room. I mean, in accounting, if they call this still income, it still leaves a room. So anyway, the point is, the operating profit or operating income is also called earnings before interest and taxes. The term earnings before interest and taxes is so self-explanatory or self-predicting, right? That is exactly the meaning of the semantics. Look at the semantics of it, right? It says earnings before interest and taxes. So as I said, that's the earnings before paying interest and taxes. Then what comes next? What should come next? What should come next? Of course, interest must come next. Interest, because it says, before paying interest and taxes. Interest must come next. Why do you have to pay interest then? That means if you pay interest, that means you have debt. You have debt. Also, is it possible? What if we don't have any debt? Of course, if you don't have any debt, no problem. There's no interest, right? It will be just zero. But you will leave this line item there. You just there is no reason to delete this line item just because you don't have interest. I mean, if you have interest, you will this will be zero. If you have debt, this will be zero. For example, this is calculated as F5. What is F5? First of all, you will have to have, that must be debt, right? And then times the, and this is the 0.63, that is the interest rate, okay? And by doing that, right? And the interest, because why does the company have debt? It's because, think about it. This company, let's say this company is starting up, right? At the startup stage, right? At the startup phase, the company needs capital, startup capital. And assume Dell, the computer manufacturer. Let's say you are Dell. And at the beginning, you need startup capital. Now, Dell is a huge company, right? But at the beginning, like Microsoft and Apple, back in 1976, when Bill Gates built its first personal computer, it wasn't Microsoft. I mean, it had the name Microsoft, but it wasn't a big, huge, company. He built the. He built manually. He built the personal computer manually in his father's garage, right? So did Steve Jobs, right? Steve Jobs built, I don't know if it was his father's garage or Steve Wozniak's garage or Steve Wozniak's father's garage, or um, they started. Why? Because they didn't have any capital, right? They didn't have any money capital. So what Michael Dell too, right? He started to build his, manually build first computer. In other words, they didn't have a plant, right? Manufacturing requires plant and equipment, but it would cost like, tens of millions of dollars or even hundreds of millions of dollars, right? To start up a like mass production facility. But then uh, at the startup stage, who would they must raise capital. So what do? There are only two sources. There are only two sources of capital, either equity or debt. Equity is, from investors. Equity is, ownership, investors in ownership, right? Uh, Two different equity and debt, right? Two different sources of capital, equity and debt. And equity means, stocks, and that means, stock, shares of stock. Share means what? You have ownership share in the company, right? If you're an investor, equity investor, you have ownership share in the company, meaning but so who is going so this their startup capital is tens of millions of dollars. Let's say just $10 million. $10 million. Who's going to invest $10 million in a company that has no track record, no nothing, just some brilliant idea and just the founder? Who's gonna invest? It's a big question mark, isn't it right? And also, then debt. Think about that. Then there's no investor. It's hard to find investor. So you go to the bank, try to borrow money, and what bank will lend money to this startup business which has only like 2, 3 people, and no plant, no equipment, nothing to put up as collateral, no assets, nothing to put up as collateral. Who's going to lend tens of millions of dollars? There's no bank that will. So in reality, this is very, very hard. In reality, it's almost it's almost impossible to raise startup capital. But if lucky, if you can find a venture capital, right? A venture capital, and the venture capital specializes in taking the risk. That's why they are called venture capital. I mean, it's like going out on an adventure for them. They are risking a lot. So let's say a venture. So I don't know how many of you have seen TV show like Shark Tank. Anybody ever saw? Um,
Yes, it's one of my favorite.
yeah.
Yeah.
Oh, your favorite? It was
Well,
a,
one,
I
yeah,
think.
I really like it. Yeah.
But what is that about? It's about this startup, businesses trying to raise capital from venture capitalists, isn't it right? Hmm?
Wait.
Angelica, because
Yeah.
you said that's your favorite show, huh?
Mhm.
Isn't that right?
Yeah. Mhm.
And the venture, so they are very critical, and they are very rigorous. They don't just they criticize why the idea is faulty, why whether it's going to take off. I didn't watch it that probably I watched it once or twice, but never, I don't have time. But um, uh, if they are lucky and if their project is selected, then they get this funding. That's venture capital, basically, right? They have a show now, but in the old days, there wasn't such a show. But venture capital will invest. If startup capital need is 10 million, why do you need 10 million? It's mainly plant and equipment. Think about it. To start up this business, right? You need plant and equipment, right? And then the plant and equipment, because in manufacturing, there is no manufacturing without plant and equipment, right? And it costs $10 million to build the plant and put equipment into. But that's not the only thing. After you have plant and equipment, you need working capital. You need working capital, right? Working capital is the operating capital that keeps the company going until you you produce and sell the first round or first batch of your products, until you generate first round of revenue from the first batch of output, right? So this is the reality. But let's say so reality is so hard to raise startup capital. But let's say we were able to raise startup capital, right? Let's say some we were very lucky. We met some venture capital, so we got funded, in equity, $5 million in equity, and then we were able to get a loan from the bank, $5 million in debt. So we were able to build our plant, and then uh, because 5 million came from debt, uh, it's a loan from the bank, and loan from the bank, we have interest. It's an obligation. We have to pay interest. So that will be the interest, right? And I just assumed, annually it was 2.5%, but all. Why did I divide it by 4? Why did I? Because all the statements are basically quarterly, right? Keep in mind, all the businesses uh, update, right? Their statements, right? Quarterly, and they have to release this information quarterly. Okay, especially publicly traded companies are obligated to release this information quarterly. So we are in October, right? October is the beginning of the fourth quarter, and every first month of every quarter is called earnings season. Why? The earnings report comes in. Earnings from what? From the previous quarter. Earnings from the previous quarter, right? Because we have the data from the third quarter coming in now, October. And then in the third quarter is July, August, September. July is also called earnings season. So July, the earnings data, second quarter earnings data comes in July, right? It's just like that. And in January, the first quarter of next year, this fourth quarter this year, fourth quarter 2021, fourth quarter data will come in, right? So all these statements are basically, quarterly, right? So you pay out interest, then I drops out from EBIT because interest is paid. Then it becomes EBT, earnings before taxes. And another name for that is taxable income. Of course, it's earnings before paying taxes. So what else is the proper name? Taxable income is the proper name for that. And then you pay taxes. And in our example, we have actually, you might say we don't have any operating income. We have actually zero negative operating income. Think about it. Think about it. From this is the net revenue, right? Sum of all of that. From net revenue, oops, I didn't, yeah, minus sum of these two, sum of, CGS and OPEX, then what do we get? We got negative number, negative 80. So businesses don't always end up in profit. That's why it is called a profit and loss statement, right? Income statement is also called profit and loss statement. I told you that. But loss is negative profit. Loss, I mean, we can, loss is, simply negative profit. It's negative. But, so this is not it. I should actually, put it there. Sum of the CGS and expense, right? And hit enter. And then we have negative EBIT or negative operating profit. Of course, then we cannot even pay any interest. But then think about it. If the tax rate and the taxable income will be, think about it. You will subtract from this, subtract this. It's negative, all negative. It will be just a bigger number in negative. But then, can it be the taxable income? I mean, if this is the taxable income, then the taxes will be negative. Let's say tax rate is 35%. So if you pay 35%, it will be a negative number. Then think about it. How can that's a crazy thing? That's crazy. How can tax be negative? I mean, what is negative tax? If taxes are what we pay to the government, right? But if the taxes are negative, then does that mean the government owes us money? The government has to pay us back? No, of course not. When we don't have any profit, right? Then we don't have any taxable income. We don't have any taxable income. That's why, it looks like, there's nothing there, but I already have, I put a formula there. I put a comment, which is maximum between, the bigger one, maximum of between 0 or J25, which is, this, right? Operating income minus interest, which is, taxable income. Now, this number will be negative now, right? Then it will be, Excel will automatically pick the bigger one. Of course, between 0 and the negative number, 0 is bigger, so it will be automatically, 0 will be automatically picked. So there will be nothing, meaning, we don't have any taxable income. We are in a loss. We don't have any taxable income. We cannot even pay this. We have this interest obligation. We cannot even pay this. Now, the taxable income, but if this is positive, think about it. If this taxable income, in other words, J25 minus J27, if this is positive, then our taxable income will be automatically positive, right? This way, Excel will automatically take care of that. You don't have to enter the number there. There's no need to enter any number manually. Excel will, pick whatever is appropriate accordingly. If it is positive, it will pick that number. If it is negative, it will pick 0. So then, since taxable income is 0, tax is 0, right? And also, I don't know if I talked about if command previously. I'm going to come back to this later. It simply means, what it means is if taxable J28 is taxable income, right? If J28 is greater than 0, in other words, if this is positive, yes, then tax will be paid. If it's positive, comma means and, right? If it is positive, then do this. Of course, we have taxes to pay. L29 is the this has to be J28. What's J28? Yeah, J28 is this taxable income. L29 is the tax rate, right? L29 is tax rate. It's not, it's hidden now, but because this formula is overlapping, right? Tax rate times taxable income, right? So if it is positive, it's going to happen. Second comma means otherwise just 0, otherwise 0. So since this is 0, since taxable income is 0, this won't be executed, but 0 will be picked. So it's going to be 0. We have 0, right? This way, it will be automatically, taken care of. And our net income then, or net profit. Finally, this is the net profit, right? This is the net profit. Of course, net profit is then from operating profit. We subtract the sum of interest and taxes, right? And then because we already have, our operating profit was already negative, it will have to be negative, right? It will have to be negative. This is our loss, right? But it this is obviously a bad quarter, right? We had a very horrible quarter. But if you have a good good quarter, right, we'll have positive profit here. So that brings us to the conclusion of the operating, income statement. And then we have one thing left here. I said, total fixed cost is only roughly equivalent to operating expenses because the focus is different. Because total fixed cost is what the microeconomics terminology. And in microeconomics, the focus is rather on the initial investment, right? In other words, what's initial investment? The startup capital. Think about it. The startup capital is the initial investment. Remember, if this is a computer manufacturing, we need at least $10 million for the plant and equipment, right? The investment in plant and equipment must be made already at time 0. Isn't that right? Because the plant and equipment, the construction will take at least 1 year, 1 year to 2 years. I mean, it cannot be done in like a couple of months. Building a computer manufacturing plant will take sometimes years, but at least 1 or 2 years, right? But then think about it. During this first 2 years, right? First 2 years, there's no revenue because we are still at construction stage. And then once in 2 years later, let's say 2 years later, the plant is finished, and only from then, the business will generate income. So for the first 1 or 2 years, there's no income. Just you are already saddled with the fixed cost of 10 million. It's a fixed cost because it doesn't change with the production level, right? And then this is basically the huge part of the fixed cost. And uh, even before generating any income, the company is saddled with this fixed cost, which is also called sunk cost. Sunk, because think about it, $10 million is sunk into this project, sunk into this business, right? Even before this business starts. Make sense? Hence, it's called sunk cost. So this is the difference with major characteristic of the manufacturing. Because in manufacturing, you cannot just open up the business and close down one day, because you cannot. Opening up the business takes a long time because there has to be a construction, right? Plan of the plant, and then equipment, right? Without generating any income while this project is, and then you cannot move. I mean, a retail can just open up, and then when you just get rid of all the inventory, you can close down and move on, right? But in manufacturing, you cannot close down and move on because you have plant and equipment until you recover this initial investment, right? With proper appropriate return on the investment. You can't close down, right? You can't close down and simply move on, right? You can't do that. So in manufacturing, manufacturing has a long-lasting employment effect, because it has a long-lasting effect on the economy. Because once you hire workers for the manufacturing, until the business fully recovers its initial investment, right? You cannot close down the business. And so for that long term, workers have job security, right? Whereas in retail, job security is hard to find, right? Job security is hard to find. And then, of course, that sunk cost, it can be also reflected in the operating expenses, because it will take many years to recover the sunk cost, initial investment. It will take many years. But we instead of timeline, in terms of timeline, we can exactly nail how many units to produce and sell to recover our initial investment. Yes, that's where the break-even analysis comes in. With the break-even analysis, we can nail the output level that will make us recover the initial investment and make profit. But that's another story. But if so it takes like 5 million units, sale of 5 million units, then you can spread it. You can spread it over fixed cost over 5 million units and allocate it monthly, quarterly, you make 10,000 units quarterly. You can spread it. It will be then 5 million units will take many quarters, right? Like 50, 500 quarters, or but whatever it's gonna take, right? But that's it for today. I'm gonna have to remind you that tomorrow the quiz 1 will start. And again, this is not the main lecture. I've been telling you over and over, this is not the main lecture. We go by the main lecture, which is the pre-recorded lecture videos in the topics folder. We're already into the third topic by main lecture, right? So don't forget, um, uh, please, also don't forget to sign into the, if your name is not here, you're not present, okay? If your name is not here, you're not present. There's no proof of your attendance if your name is not here, okay? All righty. So that's it for today. I will see you guys. We already, I will see you guys next Tuesday. All right. Have a good rest of the afternoon. And good luck on your quiz 1. Okay. Stop sharing.
Bye, Professor. Have a good day.
All right, you too, Angelica. Take
Bye,
care.
Professor.
All right, take care, Naomi. All righty, stop recording.